This is a high-level explainer of nearly every account type that a physician may find their money in through the course of their life and career. First is the checking account, your bank or credit union where you get your paycheck and where most of your expenses are paid from, be it mortgage, rent, car payment, utilities, insurance premiums, and credit card payments. It doesn't pay any interest, but it's a good way to conveniently move money to short-term expense needs and to receive money for income that you've earned. Second, high-yield savings accounts. These are typically associated with national banks that offer primarily virtual services. They might have a branch or two, but not very many. Wealthfront, Ally are examples. They're currently paying interest rates between 4 and 5%. So they're higher rates, but it's a little bit more inconvenient to move money in and out, but you can access the money within 3 days if you need it. It's a great place for emergency savings, as well as other short-term goals like saving for a down payment, saving for a new car, building up savings for a remodel, things like that. I also recently used it to replace a fence. So you can often, with both of those accounts, you can label the categories or buckets however you like to reflect the goals that you're working toward. Next, traditional IRA. Traditional IRA is a savings account that can be invested in, and when you make the contribution, you can opt to make a tax deduction. But for most physicians, you're working for an employer that offers either 403b plan or a 401k plan, and those offerings pretty much negate the tax deductibility benefit of the traditional IRA. However, the traditional IRA can still serve a purpose for you, and this would be if you were to facilitate the backdoor Roth method, which is a whole nother topic, but essentially it's one of the accounts that you have to use to facilitate money into a Roth IRA if your income exceeds the limits of direct Roth IRA contributions. It also functions well for those who are filing their taxes separately, even though they're married, for student loan planning purposes. The other account is related, it's the Roth IRA. And this would be something that residents and fellows can contribute to directly if your income is below the thresholds and you don't happen to be filing your taxes separately from a spouse for student loan planning purposes. If your income is in the $60,000, $70,000, $80,000 range, you can definitely make direct Roth IRA contributions. Now, in the case of both traditional and Roth IRA contributions, there's a cumulative contribution limit of $7,000 per year. Now, for most physicians that I encounter, what we are doing is either contributing up to that $7,000 contribution directly into the Roth, or we're using the traditional IRA to facilitate the $7,000 contribution into the Roth eventually. Once the money's in there, it can be invested. So you have many options here. You can invest it in index funds, mutual funds, stocks, bonds, and the right investments for you are going to vary based on your circumstances, your needs, and your goals. If you don't invest the money in either of these accounts, what will happen is it'll go into the default account, which is currently, for most people, it's going to be the money market fund. It used to be the case a few years ago that if you did this, you'd earn no interest, and it would be very frustrating for those who forgot to invest it. Right now, rates are like around 5%, maybe a little bit higher. They tend to be slightly higher than the rates that the high yield savings accounts that I mentioned pay. So you can also use money market fund as an alternative to a high yield savings account for emergency savings if you wish. And I'll talk about that more in the taxable or flexible savings account. That'll be coming up shortly. Nevertheless, in a traditional IRA or a Roth IRA, if you don't invest the money, it's going to sit there in the money market. But if you're putting it in those accounts, it's for retirement purposes, and you should make an investment plan for yourself. Now, we're going to talk about the taxable or flexible savings account. This is a type of savings account that you can invest in, and it can be held at the same types of platforms that can hold a Roth IRA or a traditional IRA. And I hadn't talked about those yet. Fidelity is an example. Vanguard, Schwab. Those are various platforms that can hold different investment account types. It can hold those traditional IRAs, Roth IRAs, and flexible/taxable savings accounts. Now, the benefit of the flexible savings account is not only can you invest it, but you can also access the money very easily. You cannot so easily access money from the Roth IRA or traditional IRA because those are earmarked for retirement. Typically, you're not going to plan to access those funds until you're at least 59 and a half. Now, there are some rules in which you can access your original contributions from those accounts. So if there is a true emergency, you can do so. But this should not be the intent. With these types of accounts, the traditional IRA or the Roth IRA. But with the flexible savings account, it is the intent to use it sooner. It can serve as your emergency fund. It could serve as I'd like to see if I'm capable of retiring early account, because you can access those funds anytime. And then you will either leave it in the money market fund if it is like your emergency fund, or if it's something that you think, I'd like to save this for something that's 15 years from now, then you again want to make an investment plan for these funds. There is no limit to the amount that you can contribute to the flexible savings account. So it has a lot of optionality, and you can pivot as your life changes. Now, we're going to talk about the health savings account. The health savings account would only be available to you if you are also able to participate in a high deductible health policy. Either get one yourself if you're self-employed and you get your own high deductible plan, or through your employer's plan. If they offer a high deductible plan and your current state of health is such that you don't need to use the health system much, a high deductible plan may be good for you. The premiums tend to be lower, and it gives you access to this account. As a single person, you can contribute $4,150 per year. If it's a family coverage, so that would be 2 people, married partners, or if it's 1 parent and a child, if you have family coverage, you can contribute up to $8,300 per year. This contribution is tax deductible. So if you use the funds in the HSA for medical expenses, you can pull it out tax-free, but you got a deduction for the contribution. It essentially reduces your healthcare costs by your effective tax rate. Your effective tax rate while you're in training may be 10 to 13% or somewhere in there. Of course, if you're married and your spouse earns a high income, it may be higher. As an attending physician, your effective tax rate could be anywhere from 21 to 30%. So whatever health expenses you have that you pull from the health savings account, you're getting a deduction for the contribution and then using all of that money tax-free. So it reduces your healthcare expenses by that percentage, whatever your personal effective tax rate is. You can also invest the money in the health savings account. So if you don't need to pull money from it for healthcare expenses, you can invest it. And it rolls over year to year, so it can grow. And by the time you reach age 65, it converts to a retirement style account, where not only can you withdraw funds from it for medical expenses tax-free, but you can withdraw funds from it for any expenses. Now, if you pull it for non-medical expenses, you will pay income taxes on the withdrawal after age 65, but you will not pay a penalty. So these are the personal account types. Now let's talk about the employer-sponsored plans. 403B plans are the most commonly seen by residents and fellows because most of you are working for nonprofit organizations, and this continues to be the case for many physicians after training. So 403B and 401k are very, very similar. If you work for HCA, for example, you're going to have a 401k. Or if you work for a private practice, that's going to be a 401k. For our purposes, 403Bs and 401ks are exactly the same. If you're under age 50, you can contribute up to $23,000 per year through your paycheck. And what this allows you to do is it allows you to make a tax deduction from your taxable income. This is really, really beneficial for attending physicians because you're in a high income tax bracket and you want to get as much of your taxable income down as much as possible. This account type is designed for retirement, so contributing to it is such that you're not going to touch it until you retire, age 59 and a half again. Or if you work longer, it just stays in there, continues to grow. It is invested, and by default, it will be invested in something that your employer has chosen as a default investment. This is typically called a target date fund. It's based on your approximate year that you would retire. It's an estimate, but they often have other funds that you can choose. So it's important for you to dig in and see what your options are. Target date funds are fine. They might be expensive and they might hold more types of assets like bonds than you would like to have as a younger person if you are a younger person who's early in your earnings years. But nevertheless, these are great accounts and you should max them out as soon as you get out of training. Now, many other account types are available, especially for physicians who are in academic institutions. There's 457B plans that also offer a $23,000 maximum contribution that is deductible, and you can invest in it. But 457B plans are technically called deferred compensation plans, and what they do is they allow you to put the money in there, but then when you leave the employer, you have to opt for a distribution plan. This can be a lump sum, which you do not want. You want to choose one of their 5, 10-year span distribution options, or at age 65. So you need to check and make sure that such distribution options are available before you commit to contributing to the 457B plan. Because if they're only offering a lump sum, that's not a good thing, because if you were to leave that employer, the entire account would be distributed to you in that year and would be taxable. This would very likely push up your taxable income rate in that year, which would defeat the purpose of taking the tax deduction previously. Because if you end up paying more taxes on the distribution than you avoided by making the contribution, you've just negated that benefit. So make sure to check and make sure that you have multiple distribution options that are not lump sum. There are also other types of plans. They're called like pension plans. They have various names. Sometimes they're called 415M, 401A. You just got to see what they are in terms of what the benefit is, and if the employer makes a contribution to it for you, or if they match a contribution. Every one of these plans is a little bit different, but it's good and worthwhile to invest in, like, what are these things and which ones are the best ones for me. The next one is called the cash balance plan. Cash balance plans are also like pensions. They tend to only be available to small private practices because they're expensive to maintain per employee, and they require the employer to make significant contributions to employee accounts. And so they tend to not be offered to large organizations because of that. But if you're in a small private practice, this is something where you can be putting away $50, $60, $70, $80,000 per year in addition to what you're doing in your 401k. So if your private practice offers this, or if you're looking into different partnership situations where you could become an owner, and if they offer that, I've seen many, they're fantastic ways to reduce taxable income and to get money into retirement savings for your future. The last one I'm going to talk about today are 529 plans. These are specifically designed for college savings. So if you have children, you can make contributions to these accounts. In some states, you can get a tax deduction on the state level for contributions up to $5,000, $10,000 of contributions. So you can save a few $100s per year on that. The money is invested, and then it can grow, based on what the stock market and bond market does. And then withdrawals used for education expenses are tax-free. Now, if you take it out and you don't use it for education, you're going to pay a penalty on the withdrawal, 10% penalty, and you will pay income taxes on the growth of the amount of money that you withdraw. One thing to note is that when you make distributions for education expenses, they have to be taken out in the year in which the cost was incurred. You cannot do so retroactively. And then lastly about this, there's a bit of a get out of jail free card here. If the account has been open for 15 years and the money that I'm about to identify has been in the account for more than 5 years, if it comes to a point where you realize the child is not going to use all these funds for college, you can make annual contributions to their own Roth IRA per year after that 15 years of the account open, 5 years that the money has been in there. You can make Roth IRA contributions with that money into their own personal Roth IRA up to an amount of $30,000 cumulatively. So the limit is like $7,000 per year, a little bit over 4 years. If you feel like there's going to be some excess funds, you can shuttle the money over to them for their own retirement. Now that would constitute their contribution, so they wouldn't be able to make separate contributions to their Roth IRA. But that would essentially represent their contribution. So if you did $7,000 for 2035, like that would be their contribution. But it's a good way to be able to utilize the money if it's not all going to be used for college expenses. There's a lot more details that we could discuss, but I wanted to give you a high level because there's so many different options out there, and you want to make good use of the options that are presented to you while you're in training and as you evaluate jobs that you're looking at once you complete training. Let me know if you have any questions.